Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of the financial world without needing a finance degree before we dive in. Let's just say this company is looking to make a splash in the market, and we are here to see if they have the cash to back it up. And remember, if you like getting these straight to the point breakdowns of what really matters in these filings, hit that subscribe button. And if you want to disc, use these numbers with other sharp minds, join our Discord community linked in the description below. Now this filing is from a company called Vinehill Capital Investment Corp. And it is essentially a roadmap for them to go public. This is their registration statement for an initial public offering, and it is packed with details that tell us a story about how they plan to make some serious money by buying another company. So this document was filed in late November of 2025, and it's their first big step towards selling shares to the public. They are a brand new company, meaning they have no real operations yet, and they are essentially a blank check company, meaning they have a pile of money from this offering. And their mission is to find a business to buy and combine with. The exact name of the company, Vinehill Capital Investment Corp, the FEC. They are based in the Cayman Islands, which is common for these types of companies. This is the core of it. They are offering 17.5 million units at $10 a piece. Each unit is a package deal, one share of a Class A ordinary share and 1/3 of a warrant to buy another share. At $11.50 later on, they are also giving the underwriters an option to buy even more units if things go really well. This is a crucial detail. They have 2 years to find a business to buy. Think of it like a timer if they do not find a suitable company to merge with. Within those 2 years, they have to give the money back to the investors, and the company basically dissolves, which is a pretty big risk for anyone putting money in. And they are not shy about listing those risks. Investors will not get the typical protections offered in some other blank check offerings. They are essentially saying this is a bit more of a Wild West situation. Let's talk about the money involved. They are selling each unit for $10. Now 55 cents from each unit goes to the underwriters. That might not seem like much, but on 17.5 million units, that adds up to over $9.6 million in immediate fees for the underwriters. So for each $10 unit that I buy, about $9.45 actually goes towards funding the company's search for a business and setting up operations. Here is where the bulk of the money goes. Almost $175 million is going into a special trust account in the United States. This money is strictly for buying a business or returning to investors. If they fail to find one, this is standard for SPACs, to build investor confidence. This is a very interesting point. The sponsor, who is essentially the company's creator, bought a significant chunk of shares for practically nothing, a tiny fraction of a penny per share. These are called founder shares, and they will convert into regular class of shares later. This is a huge red flag for potential investors. These founder shares, when they convert, will dilute the ownership stake of everyone else who buys shares in this offering. The people who got in early at almost no cost could make a fortune, even if the company performs poorly while public shareholders lose money. This is a classic SPAC issue that Warren Buffett himself has warned about. Now for the juicy part, the dilution table. This table shows how little value public shareholders will have in the company's assets right from the start. The shares are offered at $10. When you look at the numbers, assuming the full over allotment option, this adjusted net tangible book value per share is only about $7.33 after the offering. That means right away you are losing almost $3 per share in tangible value compared to what you paid. And look at this, dilution to public shareholders is a whopping $2.65 per share if the over allotment is exercised in full, which translates to over 26% of your investment basically vanishing on day one. That's a significant concession to the founders right off the bat. This reiterates the massive dilution for public shareholders. Their sponsor got in incredibly cheap, and that cost is really borne by the new investors. These risks are extensive. This filing goes into extreme detail about all the ways things could go wrong. They could fail to find a business to buy within 2 years. They might be forced to take on a lot of debt to complete a deal, or the chosen business might have its own set of problems. This points to potential conflicts of interest. The same people helping them sell the shares might also be helping them find a business to buy or arrange financing, which could influence their advice based on their own financial incentives. This is a big one. The people who bought the cheap founder shares are essentially guaranteed to vote in favor of a business combination. This means your vote as a public shareholder might not matter much if they decide to seek shareholder approval. They are aiming for a NASDAQ listing, which is good for potential liquidity, but they warn that delisting is a possibility too, which would make trading their shares much harder. This is a bit of a concern too. Their leadership team has been involved in past legal issues with other companies, which could create distractions or reputational damage, affecting their ability to secure a deal. Looking at how they plan to spend the money they raise, it shows they expect about $1 million in offering expenses beyond beyond the underwriting fees, and they plan to spend a significant amount on legal accounting and due diligence for finding a business to buy that. Makes sense, but highlights the costs associated with this kind of venture. Their actual working capital before this IPO as of August 2025 was practically zero, but after the IPO they expect to have around $2.7 million available for operations, and finding a deal that's the lifeline they need. Their financial statement shows a small net loss of $17,000 for the initial period that is expected for a company in its formation stage. With no operations, their whole strategy hinges on finding a profitable company to acquire and using their sponsors' money to make that happen. And if they don't, they have to give the money back to the investors, which is a key protection, but also highlights the risk. So what is the verdict on Vinehill Capital Investment Corp Thecken? They've got an experienced team, especially in the SPAC world, and they are being transparent about the risks, which is a plus. But that massive dilution from the founder shares is a major red flag. This is a classic SPAC setup where the insiders have a huge incentive to close any deal not necessarily the best deal for public shareholders. The limited timeframe adds pressure too if you are looking for a high risk, high reward VEV statement and you trust their management's track record. This might be something to consider. But for the average investor, the dilution and the inherent risks of a blank check company without a target yet make this a very speculative play. You are essentially betting on the management team's ability to find and execute a good deal under tight constraints. Alright, that's our breakdown of Vinehill Capital Invent. Statment Corp, IAS registration statement. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into the corporate world. We also have that Discord community linked in the description below for more discussions. Thanks for watching. See you next time.